Welcome to The Explainer. I'm stepping in as your virtual tax advisor today. If you own property in Spain but live elsewhere, you already know the drill. Managing real estate across borders is an amazing experience, but the paperwork? Yeah, not so much. Today, we're going to cut right through the heavy legal jargon and figure out exactly how Spain taxes your non-resident property. By the end of this, you'll know exactly where you stand. Let's dive right in and get those tax obligations sorted out.
Here is our roadmap for today. 1. The basic rule. 2. Path 1, which is rented properties. 3. Path 2, vacant properties. 4. The EU residency advantage. And 5. Calculating your tax. We're taking a real fork-in-the-road approach to break down what happens if you rent your place out versus just keeping it empty for yourself.
Section 1. The basic rule. Taxation is inevitable. Let's get straight to the core of it.
Under Spanish internal regulations, if you own real estate in Spain, it generates a tax obligation whether it's making you money or literally sitting completely empty. So the absolute first thing you have to ask yourself is simple but incredibly critical. Is your property rented out or is it vacant? Because your answer to this one question completely dictates your tax reality. There's definitely no one-size-fits-all approach here.
It's a massive fork in the road. If you're renting the place out, your tax base is built on the actual payments your tenant makes to you. But if the property is strictly for your own use and sits vacant, Spain applies what they call imputed income. That basically means they tax you on a presumed income based on the property's official valuation. Let's break down each of these distinct paths.
Section 2. Path 1. Rented properties. Taxing the landlord. Let's look at what happens when you're acting as a non-resident landlord.
The default rule here is actually pretty strict. Your tax base is the full gross amount you receive from your tenant. That includes the rent itself, plus anything else you transfer with it like furniture or appliances. You don't include value-added tax, but otherwise, it's the total gross amount. And here is the real kicker. For the general taxpayer, you compute this without deducting a single expense, zero. By the way, you're going to report this using Form 210. Now, if you choose to group this rental income annually, say for income accrued since January 1st, 2024, your absolute deadline to submit and pay is the first 20 calendar days of January in the year following the accrual. Make sure to mark that on your calendar.
But wait, there's a huge exception. Your passport can actually change the math entirely. If you're a resident of the European Union, or Iceland, Norway, and Liechtenstein, you get a sort of golden ticket. You can actually deduct expenses to lower your tax burden. You'd use the rules in the personal income tax law or corporate tax law for entities. But listen, you can't just deduct random things. You must be able to explicitly prove those expenses are directly related to the income obtained in Spain, with a direct and inseparable economic link to your rental activity.
Section 3. Path 2. Vacant properties. Imputed income explained. Let's pivot to those empty homes.
Say you've got a gorgeous villa that sits empty most of the year waiting for your summer holidays. Spain taxes that through imputed income. It's essentially an assumed financial return. The government basically says, hey, owning real estate is wealth, so we presume it generates an income potential, even if absolutely no cash is changing hands. This is calculated as a specific percentage of your property's official cadastral value, which you can easily find on your local real estate tax or IBI receipt. You also use Form 210 for this, but the deadline is way more relaxed. You literally have the entire calendar year following the accrual date, which is December 31st of each year, to get it submitted.
Figuring out this tax base is basically 3 easy steps. First, grab that tax receipt and find your cadastral value. Second, apply the correct percentage to it, which will be either 1.1% or 2%. We'll cover which one in a second. And third, you prorate it, meaning if you didn't own the house the whole year, or if you rented it out part of the time, you strictly reduce the calculation to cover only the exact number of days it was genuinely vacant.
So how do you know if you're in the 1.1% club or the 2% club? It all comes down to your local municipality. If they've revised and updated their property valuations within the last 10 tax periods, you get the lower 1.1% rate. If they haven't updated things recently, you're stuck using the higher 2% multiplier.
Of course, there are always some special quirks to keep in mind. What if your property doesn't even have a cadastral value yet? Well, you take the highest of your purchase price or the administration's verified value, cut that number exactly in half, and apply the 1.1% rate to that estimated base. Also, great news if your property is currently under construction or literally unusable due to urban planning reasons, no imputed income applies at all. And if you just own a timeshare for 2 weeks or less a year, you are completely off the hook for this one.
Section 4. The EU residency advantage. Different passports, different rates.
Now that we have our tax base, we have to apply the actual tax rate. And here is where the divide is absolutely staggering. Qualifying residents of the EU, Iceland, Norway, and Liechtenstein pay a 19% tax rate on their Spanish property income. But if you're from the rest of the world, meaning the US, Canada, Australia, or the UK post-Brexit, you're paying a flat 24%. That 5% difference is massive when it compounds year after year.
Section 5. Calculating your tax. Bringing the math to life. Let's see how this all comes together.
Let's look at a totally vacant property with a cadastral value of 100,000 euros. And let's say it's in a town that hasn't updated its values, so we have to use the 2% rate. That gives us an imputed income base of 2,000 euros for the year. For an EU resident at the 19% rate, your final tax owed is 380 euros. But for a non-EU resident at 24%, that exact same property costs you 480 euros. And remember, that's just a flat calculation. No deductions are allowed for anyone on imputed income.
But what happens if you mix it up? Say you rent it out as a holiday home for 4 months, but keep it completely vacant for yourself the other 8 months. That is a split year calculation. For those 4 rental months, you calculate the tax on the full rent received, deducting expenses only if you have that EU passport advantage. Then, for the 8 vacant months, you calculate the imputed income using the cadastral value, but strictly prorated just for those 8 months. You are literally taxed differently depending on the season.
So after seeing how drastically your tax bases, deductions, and rates can shift, are you absolutely confident you're applying the right rules to your Spanish property? One wrong move and you could be seriously overpaying, or worse, falling out of compliance with the tax agency. To make sure everything is absolutely flawless, you really should consult the professionals. You can see the logo for Optima Impuestos on screen. For further details and expert help with your Form 210 submissions, visit www.optimaimpuestos.es. Do you know exactly which tax path your property is on right now? Thanks for joining me on this explainer, and we'll see you next time.